thank you all who are here for joining today. I'm Jeff Cunningham. I'm joined by David Harwell of Renasant Bank and Michael Hopton of Southern First Bank. These are friendly competitors that I've known each of them for 12 or 15 years. And their banks are really great institutions that I consider a resource for my clients. And it's kind of the right club for the right shot. Sometimes I'll make an introduction to both of them and see who's the best fit for the client. But sometimes one's obviously better than the other. And we'll get to that here in a little bit. We have an hour, and we'll work to observe that. We've already tested out the mute and chat functions. So for those of you who have been to my breakfast panel discussions in the past, it's designed and fingers crossed, hopefully, is a very interactive experience. So unmute, ask questions. We'd much rather talk about what you want to talk about than what we guess in advance that you might want to talk about. So with that, thank you all for coming, and let me just kick off. So Michael, David, tell us a little bit about yourselves and your banks, and kind of some background. Where how did you get to where you are, and what's an ideal sweet spot client for you, perhaps? Industries you really like, industries you just don't ever want to talk to. Kind of give us a 10,000 foot view. And who wants to go first? Alphabetically, David.
Yeah, good to see everybody this morning. David Harwell with Renasant Bank. Sort of my banking career came to Atlanta, Georgia, 99, 98, worked for First Union. And at the time, that was a super regional bank. Left First Union, went to work for Piedmont Bank. Some of you guys may be familiar with that. But that was a startup commercial community bank. And that was quite an experience because you just learned to do so much at the bank other than just working with clients and lending. So it was a very entrepreneurial period in my life to start a bank. We sold the bank to a publicly traded bank in Chicago, and I continued to work for that bank for quite some time. So I've got a blend of community bank and super regional banking in my career, and I really love the community bank culture. And with the super regional, I really like all the products and services they have to offer. So Renasant Bank came calling about 5.5 years ago. And Renasant Bank is a nice blend between a community bank where we have the culture of a community bank, but we've got all the products and services for entrepreneurial companies, middle market companies. So it's a great blend. It's a tremendous culture. It's a very flat bank. So our credit decisions are all done locally, very quickly. It's a very experienced team. Most of our bankers, 20 plus years in banking. And what's kind of unique about our bank, I think, is someone like myself, I can work with operating companies, privately held companies, but also work with middle market, private commercial real estate firms. So I may go one day closing a revolving line for a growing service-based operating company, and then the next day close a $20 million multifamily development project. So that lends itself to having a broad customer base. The bank is really made up of a lot of generalists, but on my team, I do have specialists. So we bring those specialists in, such as SBA. We have an ESOP group, ABL, asset-based lending, equipment, treasury management. So we bring those partners in to kind of bring that comprehensive, collaborative solution to our clients. So that's Renasant Bank's a $15 billion publicly traded bank. We're headquartered out of Mississippi, Tupelo, kind of in the southeast, Mississippi, Alabama, Tennessee, Georgia, Florida. And Georgia is a big piece to the Renasant story. It's we probably drive about a third of the growth to the bank. So we've got a lot of resources coming in from Mississippi, tremendous support, and they want us to continue to growing out the Georgia bank. So that's a little bit about myself and a little bit about Renasant Bank.
Thanks, David.
Yeah, sure.
Michael, counterpoint?
It's more like same point. It's really interesting. David and I have crossed paths quite a bit over the years. I'm an Atlanta native, grew up in Alpharetta. When Alpharetta was a little different, really truly just horse farms back then, and started my career in corporate banking with Wachovia, and around the time First Union came in, not long after 9/11, all the blue Wachovia guys kind of scattered and dispersed and went to local banks, and that was kind of my entry into community banking, where I met Alan at Georgian Bank, and had a great run at Georgian Bank for several years, which was just a fantastic community bank. Not long thereafter, I landed at the same bank where David was at, the private bank, after they acquired Piedmont Bank. So that's where I first met David. Spent a few years there, and then left and joined State Bank. So many of you may remember State Bank, that was here in town for, a decade or so. And really, besides Georgian Bank, State Bank was my first, real entry into true Georgia-based community banking, where sort of outside of the A&D crisis of 07, 08, 09 timeframe, and really learned to be a community banker and appreciate sort of that commercial community banking space, high touch, high service with the products and services offered by a lot of the more regional, larger banks. When State Bank sold to Cadence Bank a few years ago now, I opted to stick with the community banking space and joined a bank called Southern First Bank, which is headquartered out of Greenville, South Carolina. Southern First is a fantastic publicly traded bank, about 21 years old, founded and led still today by Art Seaver. It is a blocking and tackling, relationship-based loans and deposits bank. We are not in SBA. We're not in investments. We're not in insurance. And we're somewhat agnostic to the industries that we serve outside of sort of the sins, if you will. We're obviously not wanting to lend to anything that you might read about on the front page of the Wall Street Journal. So, but if you make something, sell something, distribute something, we're out there looking to finance your building, your revolver, your term debt, your equipment loans, et cetera. And really outside of that, it's mortgages. And we've got a great mortgage company that we can put conforming mortgages on the books, as well as non-conforming that we can hold on our books as well. $2.5 billion in assets. Again, the bank is about 21 years old, about a $415 million market cap. Strong credit culture, strong relationship culture, and just a very can-do business attitude with local decision making. So not a whole lot different than David's focus, just maybe perhaps on a slightly smaller scale.
Okay, thanks, guys. Yeah. And as I said, I've sent people to both of y'all for years. So audience, these are kind of my two favorite bankers. How has COVID impacted your approach to banking or to lending, and what do you do differently than you did 15 months ago?
Well, it's lots happened. COVID. I think there's a couple of things. So we when COVID hit and PPP the CARES Act was passed, we're very relationship centric. So we got on board with PPP and delivered to our client base. And so we did, to give you an idea, we did $1 billion. I think that was 11,000 something loans in a very short period of time on a program that was being built while we were processing the loans. So we were all kind of deputized SBA lenders at that point. And I think everybody at the bank, myself included, when this happened, you wanted to help people out, but you didn't know how. And PPP kind of gave us that vehicle to help companies out. So it was a tremendous effort, really helped out our client base and some non-clients as well. And I think the big takeaway from that and where we're operating today is it sort of shined the light on some internal things that we could do better from a technology standpoint. But I think COVID also advanced the adoption of our client base on technology. For years, we've been talking about our clients about simple things, get online, bill pay, things like that, positive pay, all these different things. And I think COVID just advanced that to where if we had some clients that were hesitant to go that route, COVID sort of forced that issue. So there's some things internally that through that process of delivering 11,000 loans, we learned some things internally and tweaked our internal model to really realize we have to keep continuing to increase our technology in the bank to deliver our products and services with as less friction as possible. But also our clients started to adopt mobile banking, online banking, and different sources on how they pay and distribute cash to their business. So the technology piece is huge. The credit piece right now that we're kind of going through is looking at balance sheets coming out of COVID. Maybe your balance sheet wasn't as good, but COVID, you were in that industry that really accelerated and turned your balance sheet into something that maybe historically it wasn't. So is that something that's going to continue after COVID? And conversely, maybe your balance sheet was great and now COVID dinged it up. Is your balance sheet going to recover? So there's a lot of interesting conversations going on right now within the bank in terms of just credit and sort of the quality of the demand that's going on today and what we're seeing. So a lot of, a deeper dive. It kind of reminded me of the 08, 09 where, you'd ask, just not only your normal kind of credit questions, but then you're taking such a deeper dive. Who's your client's clients? How's your suppliers? And going deeper and deeper in how COVID affected not only your business, your supplier's business, your client's business, et cetera. So those are a couple of things that kind of are some takeaways from COVID. The other one is really business development, trying to develop, new business outside of your centers of influence. How do you do it over Zoom? A complete cold call over Zoom. So I think those are some real challenges we're all dealing with. Luckily now we're getting out a little bit more and more now with the vaccine and things like that. But those are some challenges, and we're seeing other challenges just in labor shortages and things like that. Maybe not so much with our clients, but there's suppliers that might be a manufacturer. They're challenged with getting employees back into work. So there's definitely some real challenges out there. No question.
Sure. Michael?
Yeah, you really hit on all of the critical points. I'll just add to that. Certainly PPP and the technology around it. But we sort of entered into a period of what I would call triage. We went from a set of corporate goals for the year that we had to sort of turn upside down and throw away and recreate and start a new set of corporate goals that were really around caring for our clients, caring for our employees, making sure that and this is the bank speaking to us, making sure that we all kept our jobs, and delivering and giving grace to clients as best as we could within the constraints of the regulatory environment that we all live in this industry. Certainly PPP, we did about 100 million in notes, about 1,000 notes, and we created some technology that allowed same-day decisioning and so forth. And then we took the decision to sell those on the back end to take it off of our plates and let us focus on our clients' needs and services after the fact, rather than being tied up with the ongoing PPP crisis, or maybe it's not a crisis, but PPP need. It's such a juxtaposition, as David kind of mentioned with regard to balance sheets. So many companies had their best years ever. Think of technology and consumer products. I mean, those are the top two performing sectors in the S&P last year. They crushed it. They did fantastic. But then think about the beach stocks, right? Let's see, bookings, entertainment, airlines, concerts, casinos, and hotels. In the first month of COVID, they lost something north of $300 billion in valuation. So on one hand, you've got a segment in categories, a couple that are just killing it, having their best years ever. And on the other, you've got some that are just really suffering and hurting. And so from our perspective, while we aren't banking those big public companies, the trickle down effect to the secondary and tertiary companies that support those, certainly we had exposure to. And we had to figure out how to handle both sides of that and underwrite to both sides of that. So that included, how making decisions around how much we put into loan loss reserves. What can we anticipate and forecast that we're going to see in loan losses versus new business development and supporting the companies that are just having great years, that are hiring the people that they can hire, and manufacturing and shipping and just having record years. So 2020 and COVID was a lot of triage. That's probably the best way I can explain it. We fortunately, as an organization, came out of it strong. And we attribute that to knowing our clients, having great relationships, solid underwriting on the front end, and grabbing kind of the bull by the horns as quickly as we began to see the problems that could emerge and occur as a result. So, and I think, David, really you hit the head on the business development piece. We're public companies still. We have short-term earnings pressure. We still have to perform. We have to generate new business. And doing that in this environment, it has been tough. Learning how to use Zoom. Though we are a bank and we work for banks, we're equally a technology company, and we have to be if we're going to compete and be successful. So that therefore means I have to become savvy in technology as well, which is not something I'm great at, but have become better. So it's been an interesting year. I'm thankful for it. As I look back at 08 and 09, I can look back now, 10, 12 years ago, and look at the lessons that I learned then. I think in another 10 or 12 years, we'll look back at 2020 and we may underwrite things a little differently. I think we will. The nuclear scenario that was always sort of a chuckle is possibly a reality that we all need to really put some thought and time into.
There's a forward-thinking author that I really like, Nassim Taleb, who wrote a book years ago now called Anti-Fragile, and it was his examination of how, as a people and as an economy, we tend to talk about the value of resiliency, but there are some things that actually get stronger when they're exposed to pressure, and those things he called anti-fragile and not resilient. Things that actually get better. And I wonder if through all of this, we're going to see, and observe, which businesses actually got better as the result of surviving, the COVID experience. But so you both have talked about winners and losers, coming out of COVID. And we're seeing that is resulting in a fair amount of M&A activity. People that have owned a business that kind of got beat up and are just tired, and people that have done well and have capacity and cash, and they want to take advantage of opportunities. What are y'all seeing in that space, in the M&A market, given the winners and losers landscape, and how are you reacting to that? I'm going to let you go first this time, and you go second.
That's a great question. At the end of 2020, you could not even get, deal attorneys were booked. The last quarter of 2020, the M&A banks were booked. You couldn't get underwriters to work on your deal. I think that was a combination of sort of the political environment, the tax environment, just the volume of private equity money that was ready to be deployed, looking for a return, and just sort of some positivity on the vaccine had been released in the November-December timeframe, so there's this swell of positivity that came about in the last quarter of 2020. I haven't seen that volume in the first quarter of 2021. I think it's slowed down. I think things are a little bit wait and see. I think certainly the tax plans that have been discussed and capital changes to capital gains have brought some concern to folks on whether they wait out this next intermediate election that's coming up in another year and see what happens. But certainly that volume is there, and we're seeing it. But I don't know that I'm not seeing it as much on the 10 million in EBITDA and above scale. I'm sure that it's there. I just haven't seen as much talk or hear of as many deals locally that are going on. Certainly in that subspace where kind of the moms and pops that are ready to be done, ready to hang it up. There's always a strategic seller or buyer, a strategic or a financial buyer out there looking, and a comparable seller that's ready to sell. So there's still deals certainly happening. Maybe you have a better view on it from the SBA side.
Yeah.
The SBA program is just a great way to make those things, to finance those deals.
Yeah, I guess we're expecting some M&A. What I would say what's going on in the market now, there's just so much liquidity out there right now. So using senior debt financing for M&A is, I don't know how robust that is right now because there's so many other sources. Now, will that pick up? As Michael's alluding to, there's taxes, there's trial balloons of what corporate taxes, et cetera, are going to look like. And maybe that spurs some M&A activity at some point. But yeah, certainly in the more entrepreneurial companies, we're seeing more kind of partnership buyouts. And that's something where the SBA will come in and set up some pretty attractive financing. And so we generally use in the smaller companies kind of that SBA to finance some of those smaller M&As or partnership buyouts. But I haven't seen any robust M&A deals, year to date at any activity. So
I met with a local debt capital equity group.
Yeah,
they raise equity.
Yeah,
they're putting money out in debt structures, unitranche structures, that type of thing. And they've done one deal this year, north of EBITDA, and that's an Atlanta firm. They've done one deal this year, and it wasn't even an Atlanta company. And so they're out calling on banks saying, "Hey, can we? You guys know anyone? I mean, can we get some deals going?" So I think it's to be seen.
Yeah, I think so. Yeah,
the PPP liquidity that's being held on a lot of companies' balance sheets is, that's an interesting dynamic and how that's going to play out over time. There was no representation of need.
Right.
You didn't have to prove that you needed those funds.
Right.
So there are a lot of companies out there with sort of quasi-free capital on their balance sheets.
Right.
Was fully forgiven that, they don't need David or I this year.
Yeah. They went round one, they got round two. Round one was forgiven. Now round two, they liked how it worked round one. So,
well, and if it's if the loan has not been moved into the forgiven category and there's an M&A transaction going on, you have to escrow the entire amount, plus $25,000 or something like that.
Yeah.
I have one of those going on right now. That's it's a very large buyer, and that it does not have to have bank financing to write the check, and and it's a good sized transaction, and they're escrowing the entire PPP loan, and the ones that haven't been forgiven are the ones that are pretty big. So I'll give you an idea of the amount of money that's being escrowed in this case. It's a lot. Very important to the sellers. I'll say that.
Yes.
As you can imagine.
I think that another piece of the M&A in just general banking world that we're going to see evolve is just the credit metrics of deals. We're seeing, at least on the debt side, the senior debt side, man, we're seeing deals get really sporty. There's a lot of banks out there that are, we're seeing loan to cost, loan to value numbers creep back up to the 85% range. Fixed rates in an inflationary environment, fixed rates with no prepayment penalties in the low threes, high twos in some cases.
Yeah.
High advance rates.
High High leverage rates.
High leverage rate, long terms, long AMs, and we I think collectively as a industry, we have to be careful with that. We have to not. We just really have to be careful, and I don't know if you're seeing that, but we certainly are.
Yeah, competition's at an all-time high. Like I said, there's a lot of liquidity, not only in companies, but on banks' balance sheets too. So we're looking at every avenue to grow. And at the same time, we all as a banking industry still have exposure to retail hospitality in every bank's portfolio. And we don't know how that's going to perform at the end of the day because there has been so much rescue capital. So banks are still watching that. Banks are trying to grow, tremendous liquidity out there. So as Michael said, the industry has to grow, but we need to maintain some discipline on how we grow our balance sheet at the bank. And that's got to be key with all the past experiences of 08, 09, 2010.
Any thoughts on the coming hospitality boom as people take, their first vacation in 18 months this summer? And how is that going to be impacted by the pipeline and oil prices and, $4 a gallon gas? Prognosticate, guys. Come on. We're being recorded, so go ahead and go on the record.
Yeah. Let me tell you exactly how it's going to play out.
Exactly. You got the crystal ball. Without question, hospitality is just a big question mark. And the book that we hold, thankfully, we are in tourism areas, Charleston, Myrtle Beach, some of those areas where we have our hospitality exposure. And we have begun to see the tourism side of hospitality return. I think the bigger question mark is business travel. Now, layer on top of that, the Colonial Pipeline disaster.
Right.
As we enter into the end of school, beginning of summer, first weeks of June, when everybody's ready to head to the beach and go to these tourism hotels, we might find that we are glad we didn't take those loan loss reserves back into income like we thought we might.
Right. Yeah.
So prognostication. I don't know what's going to happen.
Yeah. Yeah. It feels like everything's just based off the vaccine. The more and more vaccines, maybe the more and more travel. But and we have some exposure to hotels. I think it's destination driven. But interesting enough, I talked to my SBA lender last week, and they're doing hotels under the SBA. So the SBA is giving banks a higher guarantee. SBA is waiving the guarantee fee right now, and the first 3 months of payments are covered by the SBA. So I think, there is some recovery.
Yeah.
I think it's probably going to be very selective, the recovery. Sure. And there actually is some financing for hotels under the SBA. So
what I'm hearing, and tell me if I'm hearing it wrong or right, is that y'all are underwriting in a less homogenized environment and more of a micro examination environment. It sounds like, and that's
it kind of goes back to who's the sponsor, what's the management company. Really getting a feel for how they think, how they operate, how they operated through COVID. I mean, those are great discussions to have. And then what is the industry, real estate? What is the submarket?
Right.
That's exactly kind of I think where we're kind of positioning our credit.
Well, if it's a hotel, and to your earlier point about who are your vendors and who are your customers, who stays at this hotel?
Yes.
Who is it being marketed to? It's not only where is it, what dirt is it located on?
Yeah.
But who is it? Who stays here?
Yeah.
And what's going to happen to those people?
Well, it's a good point. Our SBA lender was
feel free to write that one down.
It's being recorded.
Okay.
I just listen to it over and over.
Yeah, it's good stuff here.
But some of these hotels are being, with the labor shortage, some of the hotels that are not necessarily destination, but they're close to different projects where employees are traveling, they're staying in these hotels all week, and they're actually doing really well in some markets that, were a little surprising. So, so it's a little bit all over.
There's an interesting article that came out this week that I read. It's about Airbnb. Just kind of while we're on this topic a little bit, an Airbnb, had an IPO, had a whole bunch of money, did way too many things. Kind of took almost a dirt nap for a while, and now has a plan to come back doing narrower, fewer things and doing them better, which is always a good strategy. But one of the things that stuck out to me in this story is their prediction is that business travel is not going to be as much, executives go to the place. It's going to be, executives go to a regional hub and bring people to them for, that change would impact hotel business too a lot. I hadn't thought about that, but I'm interested to see how that plays out. Anyway.
Yeah. I mean, I think when we start to see and I'm not following these metrics closely in probably the last 24 months, but when we start to see the RevPAR, maybe not occupancy so much, but when we start to see RevPAR start to tick back up.
For anybody that doesn't know what RevPAR is.
Revenue per available room. So, $129 a night versus $89 a night. And there's some industry reports that make that data available on comparable hotels. And when we begin to see RevPAR tick back up, that's when hotels will begin to open floors back up. Many are operating, if it's a 5-story hotel, they're only operating 2 floors. So they can cut down on their expenses. Heck, they may not have the people to clean them anyway.
Right. That's right. Yeah.
So as those lower 2 floors begin to generate more income, occupancy will come back and they can open up another floor. So it's, but whether there's gas to get there is a question.
Yeah.
Gosh.
All of a sudden.
All of a sudden.
Well, everybody should just buy a motorcycle like you and get better mileage.
Yeah.
Okay, so we've been talking about loans and kind of industries and, what's good for an SBA and what's, not good for an SBA loan. What's the approval process? From a timeline standpoint, from who's in the room to make decisions? Does this go off into a black box that, goes to Mississippi or Greenville or, tell me at your particular institutions, how that works. And anybody can go first.
Yeah, we are unique in that I wear almost all of the hats when it comes to putting a credit package together or a loan package together. From the initial contact with any one of you or your colleagues to gathering your financials, working with you to structure the deal, advise on a different structure that maybe makes more sense, whether it's a split between temporary and permanent working capital or what have you. Developing and building out that structure, gathering your financials, actually spreading your financials, underwriting it, and then seeking approval is sort of 100% me up until that approval timeframe. We make most of our decisions right here in Atlanta. And I'll get back to timeline in a moment. And anything that's north of a couple $1 million, we add in a couple of other folks from Greenville, and we turn those things around still within a few days once we reach the decision timeframe. In terms of timeframe, the labor crisis has hit us as well. We need more people. We want more people. We're out on the hunt trying to find more bankers as well. But that being said, whereas we used to be able to get things done in, call it 25 to 40 days, I would add at least a couple of weeks to that. It's a 30 to 45, maybe as much as 60-day turn right now. There is a lot of activity in the market, just a lot of activity. And for all the reasons that we've already talked about, interest rates are low. We're in an inflationary environment. Folks know rates are going to start creeping up. A lot of companies that sat on the sidelines last year are ready to do business. That PPP money is there. They're ready to spend it. And so all of those things create activity for us as bankers to find new loans and new deposits. I wish it was a little faster, but it is a labor-intensive process. And back to what we talked about a while ago, underwriting is key right now. We saw the nuclear option happen last year, so we want to figure that out to the best of our ability. We're going to ask you to unbutton your kimono a couple of more buttons, and we're going to dig deeper. And I think you should be ready for that. If you're in the market for a new capital facility, expect to be asked questions that you probably haven't been asked before. And frankly, don't be offended by it. We're going to want to know who your largest clients are, who we're probably going to get into your accounts payable aging deeper than we have in the past. The other thing that is taking time is third-party reports, appraisals. Gosh, think of a housing market and the amount of time it's taken appraisers to get things done. Commercial appraisals, you could generally count on 20 to 30 days maybe. The commercial appraisals are taking as much as 40, 45 days now. Even title work is just taking a lot of time. So the entire process has slowed, not to a crawl, but certainly slower than we would like it to be.
Yeah, we're seeing some of those same themes as well. And not to rehash what Michael said, probably the way I'd look at it is you should be with a banker that has built a relationship not only with the borrower, the management team, but also with the borrower's CPA, the borrower's attorney. And if you've built that relationship and it's a deep relationship and you know the company, know the real estate project, what have you, those existing clients, you can get those through, I think, a little bit quicker because you know the background. I would say the 60-day is probably a good timeline. And with something brand new, it might be a little bit longer because you got to get up to speed with that company, with the real estate project at hand. Right now, where the flow is coming from is, right now is kind of our selling season, if you will. We're getting fresh financials coming in, whether it's personal, corporate, reviewed financials, audits, tax returns. So those are now coming in. So we're reviewing the year with our clients, but also working with new prospects as well. But we're trying to work every day to make it as less friction as possible. And I think that's key, to find a bank that fits your company and interview bankers, their experience. What does their bank like? And so I think that's also key. And just having communication ongoing prior to the initial request. So I think having a team of trusted advisors that the business owner works with and they all kind of work together will accelerate the eventual loan request.
What can a business borrower do on their side to speed up the process? So, if somebody comes in and they say, "Hey, I just think that I just thought about maybe getting a loan," versus somebody who comes in and has their ducks in a row. Well, what do those ducks look like, and what does the row look like?
Yeah, listen. David touched on the point that have a good set of financials. Know your financials to the best of your ability. Work with your accountant to understand your financials. Have a good debt schedule. Have a good personal financial statement form. Have a handle on your tax returns, where they are, access to them. And if you're like a lot of real estate folks with just a dozen or more K1s that are kind of spread out from all sort of different companies, have those things ready to go, or make the introduction to your CPA so that we can request those things. A good handle on what you need your loan for. Is it a refinance of an existing loan from another bank and you're interviewing a new bank because you're not happy? Or have you just sort of had a day-to-day checking account relationship with your bank and you've reached a point where you need the advice and counsel of a professional banker? Either way, have given that some thought, and talk with your CPA, talk with your attorney, ask them for who they recommend. We again, to make that point, we love when we know your attorney and when we know your CPA, and we can be the third leg of that stool. But that kind of having those items readily available really helps. Helps the process.
Yeah, I can't add much to that. It's have a CPA firm, good bookkeeper, what have you, for internal financials. But that's the key, being able to get information to and from the bank as quickly as possible so we can move through the process. And that may start just with an initial phone call from your CPA. Maybe you're having a conversation year-end CPA or with Jeff, and you're thinking about doing something 6 months down the road. Let's go ahead and have a conversation now about that, and we can recommend things to your specific situation on what we're going to need and how to get the best probability of getting that loan request cured. So I think that's it. It's really just kind of getting the financials together to the extent that you can.
Yeah. I want to remind our audience that, you can unmute and ask questions if you want to. We'll keep talking, but if you have a question, please don't hesitate. So gentlemen, I'm always interested, you both know that I have a background. Before I went to business school and law school, I was a grocery store manager, and I learned as a grocery store manager that Kroger can do so many things people just don't know about. People go in there and take stuff off the shelf and they shop for their own groceries and they leave. And there are probably 100 different really cool things that, that just about any local grocery store, can do that people just don't even ask for. So that has always fascinated me about other businesses too. What resources or capabilities do your banks have that your customers don't know about, don't take advantage of? Just tell me something really cool that that you do that people just don't ask for, or that you could do that people just don't ask for. About banking, Michael.
Thank you. It's important.
You had to narrow it down.
I appreciate it. I was over here.
Yeah, I know. Come back.
Anything? I'll go ahead.
Well, go ahead. You go.
Maybe the
I did dibs on these questions.
Yeah, maybe the softball for us is community involvement. I don't know that a lot of our clients know, and the folks that we call on a regular basis know how involved banks in general, our bank included, how involved we are with the community and the things that we do in Atlanta. Atlanta Humane Society. It's a fantastic friend of the bank who we all go out and volunteer for and do work for and partner with for things. They're the oldest non-religious charity in the Atlanta area that has branched outside of Atlanta. Community food banks, and the list could go on in each of our markets, but community work is a big piece of interacting with and participating in and around the community that probably a lot of our clients and prospects and folks we talk to on a daily basis just don't know about, that we probably should do a better job talking about.
Yeah, probably. We along those same lines, we're real active in junior achievement, and credit to a lot of people in the bank. Even through COVID, we've had numerous Zoom meetings with school-age children, teaching them really financial 101, kind of consumer finance 101. And that is critical because it's not really being taught broadly through most of the schools. So that's I think a key component. And one thing on the more kind of entertaining side is our bank does a pretty good job of branding the bank. And I don't know, we're in the Southeast, so it's a big kind of SEC kind of culture, football and things like that. But we've got really, I think, pretty funny short takes that we sponsor during the football season. And if you've never looked at it, go to our website and you can pull up SEC short takes. And they're absolutely just hilarious little short takes on what happened that week in the SEC in football. And so with all the fatigue of COVID, it's a great way to just kind of take 2 minutes out and just kind of laugh a little bit. But so that's kind of a neat resource, I think, that we offer out there in the world.
Very cool. All right. I did not know that.
Yeah, you got to check it out.
I'll go check that out.
Yeah, it's a good time.
So you mentioned early on, adoption of technology and turning the flashlight on yourselves.
Yeah.
Sure. Talk about that. What do you do differently? What what are people using more? And then that's
I think internally, I think COVID's a reset for every company and for ourselves. We've got new technology internally, how we handle our loans, end-to-end loans, how we're processing it, setting up CRM, so we have a better database there. But really trying to do what we can to make this, 45, 60-day process quicker. We built out something, dashboard for each of our bankers so we can manage our portfolio better. We can stay on top of it a little bit better, which means we can work with our existing clients and help, strategize with their business a little bit more. So all of these things that are going on internally, we're trying to really digitize the bank. And that, I focused a lot on the loans, but we've also kind of beefed up our mobile banking too, as well as our treasury management, how a company collects and disperses their cash. So that's been a big investment, and it'll be an ongoing investment for our bank as we continue to grow. Just really trying to streamline. As every company has a lot of systems, we're trying to streamline down to as few systems as we possibly can. So, and that's quite a process for our bank to do that.
Now, has Renasant, has it been a branch-heavy bank and in-person walk-in, or is there a change afoot there?
Yeah, no, there is, and I probably left that out. We've been around 100 years, and I would say we've acquired several banks. I may have my years off, but around 06, 07, we started acquiring some banks, one every other kind of year. So we're a light branch bank because we feel like there's a lot of technology out there where you can do a lot more now with fewer banks, fewer brick and mortar banks. But as I mentioned earlier, COVID has accelerated some of our clients adopting new technology. That some of the technology, quite frankly, has always been there, but through COVID-19, we're adopting them. Quite like myself. I mean, Instacart. You mentioned grocery stores. Instacart has been there for years, but until the pandemic, we didn't really use it.
Right.
And so, I find myself using more and more different apps and technology now. And that's certainly true with the bank as well. So we're kind of like, we're seeing lighter traffic in our retail branches for sure. We're always going to have them. There is a need. I don't know if we are going to have a high volume of them, but there is a need to have them kind of maybe more strategically located.
Sure. Michael?
Yeah, I think, pre-COVID, our reliance on technology was somewhat linear, and, post-COVID, it's exponential. It's absolutely exponential. Thankfully, only being 20, 21 years old, Art and his management team saw that technology was going to be the way, and they did not build out a heavy branch infrastructure to begin with. So we're in 8 markets now, and we've got a branch or two in each of those markets, from Atlanta, Charleston, Columbia, Greenville, a suburb of Charleston, Raleigh, Greensboro, and Charlotte. So we have a branch in each of those markets, and the technology to support them. We're not an M&A bank. We haven't bought our way to our size. We've grown organically, so we've had to have the technology to sort of keep all of those offices and integrated, and then make the availability of our products and services easy to get to and easy to use for clients. So, a lot of technology renaissance for us started with the PPP. I mean, we had to create a solution for folks to log in and input and create and request a PPP loan, which we did in-house. And that process led to sort of a sweeping change through our systems of new client access all the way out to the mobile platforms and online banking platforms. Some of the things that we have available that have become more useful to clients, Zelle, same-day ACH, the ability to move money electronically with minimal or no fees, with no delay in availability of funds. Those things were not as available a year ago as they are now. Or at least we hadn't made them available. So to that point, we are as much a technology company as we are a financial provider, and and I think all banks, in order to succeed and grow, will have to do that.
Okay. So a lot of our attendees and people that will watch this, when it's released from recording, are in growth phase businesses. They're entrepreneurial. They have either taken on some outside capital for growth, or they're thinking about taking on some outside capital for growth, and they're, in that kind of, always looking for the next dollar and next client, and the wind tunnel of everything's new. Do your banks connect customers with potential business partners or investors or supports of any kind? And what does that look like?
I would answer that to say, not so much the bank, but me individually. It's an individual thing. I think every banker at my bank or other banks has a Rolodex, and part of what makes you a good banker is that you are a connector of people. And where you see the opportunity to make a connection, whether it's for an attorney, a CPA, or outside capital, then you want to do that because you want to help and serve the client. And so, yes, to answer your question, absolutely. I look to make connections and introductions wherever I can, because that's the right thing to do, and it helps your client or your prospect.
Yeah, certainly. Michael hit the nail on the head. It's not so much a bank; it's more the commercial banker that you're working with, and we are connectors of all sorts of support and resources. And I think that's another question, as maybe you and his advisor or a direct borrower should ask your commercial banker, sort of what I call a center of influence. Who do you work with? What firms do you work with? What other resources can that banker help you and your company or your real estate firm, achieve the ultimate success? So it's very much a referral platform to help Michael and I both grow our portfolios and help the bank and help our team. So.
Okay, we're at 9:56, so I'm just signposting a little bit. We're going to start wrapping up. We included your contact information on the invitation that went out, but recording and putting this on the internet. How can our viewers get in touch with y'all? David?
They can call me. Cell phone 770-310-7001. That's kind of the best place. Or they can email me, david.harwell@renasant.com. That's the best place.
Sure, absolutely.
Yeah.
Well, one of the reasons
I'm not hard to find.
That's
or LinkedIn. That's probably the other
sure.
Easiest place to find me. So
sure.
It's funny. I'm old school. I like phone calls. I get text messages and certainly emails, but I like to talk on the phone. And so call me. Yeah, 678, cell phone's best, 678-478-6513. That's 678-478-6513. Or email me at mhopton, MHOPTON, @southernfirst.com. Would love to help and connect.
Yeah.
And LinkedIn.
And LinkedIn. And I obviously can put you in touch with both of these gentlemen at any time. They're at the top of my personal Rolodex, and I appreciate both of you making time for this talk and for our audience today. Glad to be here. Any questions? What did we not cover, if anything? Because we still have a few minutes, and we want to be attentive to your thoughts, concerns, questions. Okay, Helen.
Jeff, it's Armstead.
Okay.
And
Armstead, then Helen.
Yeah. Excellent presentation, Jeff. Thanks for putting that together. I've known Michael and David for a long time, and clearly what's been evident to me, and I think all of us in the last 14 months, is where banks have been the distribution channel for government's fiscal packages. And you look at what happened in the last year, that's 15 years worth of SBA loan production crammed into 1 year. And you both touched on it, where you're a more resilient and agile organization than you were before. And I think that trend is what separates you from some of the bigger banks that have a lot of legacy anchors that are towing them down. But you both have been through several business cycles as well, and the credit metrics that have worked in the past will work again in the future. So 2 to 3 years out, I think we will see some challenges. You both alluded to that. I don't know if you're getting the appropriate relief you need out of the regulatory department. Michael, you mentioned generating $100 million in loans and selling some of those off, and clearly that makes sense so that you're not putting pressure on your capital ratio. So are you seeing any kind of friendlier faces from the regulators than what they typically have shown in the last 20 years?
That's a good question, Alan. Not anything that I can touch on. In this new administration, it's going to be, I think we'll see some clawback on some of the regulation that we saw prior, but I can't speak to anything specific. But it will be an interesting to watch and see.
Yeah, likewise, I can't point to anything really specific. Our second round of PPP, we outsourced to a different company. For the most part, our clients have gotten loan forgiveness. What'll be interesting, though, with the rest of the PPP loans, as you may or may not know, because there's a guarantee from the SBA, if you don't cross every T and dot every I, that guarantee, if you call on it, will be impaired. So I think we still have some runway there. I say we, the whole banking industry, to see how that's going to really play out with the rest of the loans that are being submitted for loan forgiveness.
Armistead, you had a question?
Yeah, so we're right at the top of the hour. I apologize. So Michael, you mentioned, and maybe David as well, I might have missed it, you do some loan origination. I'm just curious, and you sounds like you keep some of the paper. During the beginning of this, were you getting handed any keys to houses, or nothing like, I'm assuming nothing like Great Recession sort of issues?
Yeah, Armistead, good question. So we have a traditional mortgage group that is originating conforming and jumbo mortgages that they're selling off to third parties, and then we have mortgages that we'll underwrite and hold, on our books. And thankfully, that portfolio of business has held up superbly. It gets back to a little bit more of our relationship strategy. We're generally not making those loans to folks that are, call it, first-time home buyers. They're folks that we fully underwritten as though at least we know they have the capacity to pay, and reserve certainly if things go haywire. So we've been in good shape on that side.
Yeah, likewise. I mean, we're portfolio lenders on all our commercial loans. What I've heard out of our mortgage group is, last year, I think all of us, nobody was quite sure how COVID was going to play out. And the government backed everything, I believe, other than equities. And so if your question is more about real estate, residential real estate mortgages, there was forbearance. Anybody could get forbearance. And I don't remember the details around how long that forbearance was, because I think there was a couple of different rounds of forbearance. So that's another area to keep your eye on. Although it just doesn't seem like it's going to be as massive as previous cycles in terms of residential real estate. But it is something that, all banks, I think, are keeping their eye on right now. And I don't think it's fully played out just yet. So
it's a good point.
Yep.
Yeah, got it. Yeah, but the forbearance could be a little bit of a delay to something coming.
Yeah, I would say this fall is going to be interesting to see.
Mm-hmm.
All right.
Well, we're at 10:03, and if anybody has last minute questions, we'll field. Otherwise, I think that we'll give everybody back their day. I know that my panelists have appointments to get to. So I appreciate their time. I appreciate your time. Dee Dee, nice to see you up in the window. I think you're on audio. Let's talk and have lunch.
Yes, I'm good. Look forward to it.
Okay.
Thank you, guys, ladies.
Thank you, guys. Yeah, ladies, gentlemen.
Thanks, everybody.
Thanks.